Welcome and get ready to dive into the thrilling world of investments, where numbers dance, money talks, and the unexpected always keeps us on our toes. Today we are talking about SoFi Technologies. A few weeks ago, Morgan Stanley downgraded SoFi Stock to underweight, citing that the stock should be valued as a traditional bank rather than a fintech company. Today, we are going to do exactly that. In this video we're going to compare SoFi Technologies against other traditional banks as well as other fintech companies. So if you want to see this comparison, go ahead and smash that like button right now. Comment your thoughts down below. Subscribe if you are new, because that's what keeps me here on YouTube. SoFi Technologies is a fintech or financial technology company with a primary focus on digital banking services. It started as a firm specializing in student loan refinancing. Over the years, the company has made its footprint in so many areas of financial services that are in direct competition with traditional banks. SoFi has gained significant popularity in the stock market, with its price up 87% year-to-date. Our coverage of this company has been ongoing for some time. In this video, I intend to dig deeper into their business model and explain what sets them apart from both conventional banks and other fintech enterprises. From our previous videos on SoFi, you know I maintain a bullish view of this stock for the long term. While I will remain neutral and let the data speak for itself, I do think by the end of the video you will see how the analysis is reinforcing the positive stance towards this stock. Let's begin our discussion with their Chief Executive Officer, Anthony Noto. With a background as a former investment banker at Goldman Sachs and experiences in high-ranking positions at Twitter and the NFL, Noto brings a wealth of expertise that can greatly contribute to SoFi's sustained success. Over the past few years, SoFi Technologies has strategically acquired several companies. These acquisitions have played a pivotal role in shaping SoFi's trajectory today. Among these notable acquisitions are Galileo, a banking-as-a-service platform, Technicists, a digital personal finance platform, and Wyndham Capital, a mortgage firm. Each of these acquisitions has been meticulously executed to align with SoFi's long-term vision, positioning the company for prosperous growth in the future. These deals have not only significantly boosted SoFi's branding but have also positioned them advantageously beyond the capabilities of traditional banks. Remember, SoFi was only specializing in student loan refinancing when it started. Today, SoFi still remains as the key player in student loan business. At the same time, the company has also traversed a more comprehensive path from its starting point, showcasing impressive evolution and expansion. Let's now turn into how their business model not only ensures their present success, but propels them towards even greater achievements in the future. SoFi Technologies essentially serves as a one-stop shop for various banking necessities and even certain investment needs. The fundamental strength of their operation lies in their adeptness at both cross-selling and upselling to their existing members. SoFi's ability to attract new members is strikingly good. Their marketing is so effective that SoFi can easily lure customers away from other banking institutions. To demonstrate this idea, in the second quarter, concluding on June 30th, SoFi added a total of 6.2 million members on their platform. This marks a remarkable 44% year-on-year expansion in their member base. This influx of new members allows SoFi's operational model to come into play, one that resembles flywheel business model, to systematically cross-sell and upsell on other SoFi products. For instance, maybe initially you go to SoFi primarily to obtain their credit card. After a while, you'd also find them offering other financial solutions tailored to your unique needs, such as personal loans, student loan refinancing, or the establishment of a checking or savings account. This approach proves effective not only in driving SoFi's revenue, but also in creating a unified platform that caters to all your financial requirements, replacing the need for multiple finance or investment apps. This successful approach has significantly fueled SoFi Technologies' revenue generation. For instance, in the second quarter of 2023, their revenues surged $498 million, just shy of the $500 million mark. Putting it in perspective, this represents an impressive 37% compound annual growth rate year over year. Now that we've examined SoFi's strategic plan and capacity to expand their member base and revenue, let's explore how their valuation aligns with their share price. As investors, we want to search for favorable deals when buying company shares. Here we are going to leverage an article on The Motley Fool. The author evaluated SoFi Technologies using their price-to-sales ratio and price-to-earnings multiples. As of now, SoFi's market capitalization stands at $7.7 billion, with an enterprise value around $11.4 billion. Notably, SoFi's valuation is comparatively lower when compared to several private competitors like Stripe, Chime, and Plaid. While it's challenging to make direct comparisons between publicly traded entities like SoFi and private counterparts, it appears that SoFi's valuation surpasses that of those private companies in the industry. Next, the author puts SoFi side by side with its direct peers in the traditional banking sector, considering their price-to-sales ratios. As displayed in the chart, we have SoFi Technologies alongside Wells Fargo, JP Morgan Chase, Morgan Stanley, and the Goldman Sachs Group. Not surprisingly, SoFi's valuation appears higher with a ratio of 4.1. In comparison, JP Morgan is around 3, Morgan Stanley at 2.8, Goldman Sachs at 2.5, and Wells Fargo at 2, which is the lowest of them all. While SoFi's price-to-sales ratio is higher than the banks, we should consider their compound annual growth rate, or CAGR, in revenue growth. If SoFi's CAGR, currently at an impressive 37%, is significantly higher than that of Wells Fargo, for instance, then SoFi's valuation holds merit. Consider Wells Fargo's PS ratio of approximately at 2 and SoFi's PS ratio being at 4. If SoFi's revenue CAGR is twice as high as Wells Fargo's, it implies that SoFi Technologies presents a more compelling investment. We know SoFi's compound growth rate is at an impressive 37%. What is the number for Wells Fargo? Well, it is at 8.02%, less than a quarter of the revenue growth from SoFi. To sum up, despite the seemingly elevated PS ratio, SoFi's substantial annual revenue growth, which will progressively reduce the PS ratio, makes them highly competitive within this context. This perspective implies SoFi has huge potential value. Last but not least, it's worth noting that SoFi's profit margins have shown remarkable improvement, climbing to about 16%, more than twice the figure from a year ago. This dynamic reflects a rapid enhancement in their financial performance. With strong fundamentals and a promising roadmap, holding on to shares of SoFi Technologies for the long term seems prudent, in my humble opinion. How much of your portfolio should you consider investing in SoFi stock? In my perspective, I wouldn't suggest weighing more than 3% to 5% of your portfolio to this particular company. I would opt for a biweekly or monthly dollar cost averaging strategy, consistently investing a fixed dollar amount until the stock constitutes 5% of your portfolio. This approach ensures that your purchase price is spread out across an extended time frame, resulting in a competitive average price for the company's stock. This strategy becomes especially effective if you're open to holding on to this investment for the long haul, positioning you well for potential future growth. However, once you've reached this cap of around 5%, my recommendation would be to allow the remaining investment to continue its trajectory for the long term. This is because this company has the potential to deliver substantial value over time. That said, I'm eager to learn about your viewpoints on this matter, so please feel free to share your thoughts in the comments section below. Don't forget to go and hit that like button and subscribe if you are new. Support me personally and keep me here on YouTube. Thank you, and I will see you in the next video.